Today the topic is prospective financial statements, and the standard which provide guidelines for prospective financial statement is ISAE, International Standards on Assurance Engagement 3400. So ISAE 3400, that is prospective financial information. So actually if I take this prospective financial statements, it is like this. Normally, you all know the IAS 1 standard, preparation and presentation of financial statement. If I take this standard, basically financial statements need to prepare going concern basis. Financial statements need to be prepared going concern basis. So as management responsibility to prepare financial statement going concern basis. And who should assess going concern? And who should assess going concern? Management should assess going concern. Right? So management need to prepare financial statement going concern basis. For that, management need to assess going concern. The assessment period may be differ, but it should ensure that entity need to be exist. Entity should be exist at least for next 12 months. Right? For that, as I told you, we should management should assess going concern. How they could assess going concern? How management assess going concern? One of the method is preparing forecasted financial statement. Preparing forecasted financial statement. So PFI means that prospective financial statements, forecasted financial statements. So the financial statements that you prepared for the future, forecasted one is known as prospective financial statements. And actually there are two types of forecast we know, right? One is forecasted profit. Two is forecasted cash flow. Forecasted profit and forecasted cash flow, right? So let's take this PFI, prospective financial statement. So prospective financial information, and we're going to discuss this. So management normally prepare financial statement and they need to ensure that particular entity is going concern. For that they prepare prospective financial information to assess their going concern. One reason. Right. Another reason why we prepare PFI, basically as a part of your financial statements, right? In the annual report, projected or expected financial statement, forecasted financial statements also prepared along with historical financial statement for comparative purpose. For comparative purpose. For that also we prepare what? PFI. Another reason why we prepare PFI, basically if I take the financial statements, we can submit these financial statements to obtain a loan. Then the bank or financial institutions, they might request us to provide a forecasted financial statements. So it can be forecasted profit or forecasted cash flow, right? So forecasted profit statements or forecasted cash flow statements, right? So let's move the PFI. So we're going to discuss what is PFI. We're going to discuss what is forecast, what is projection, what is hypothetical illustrations here, and the principles, procedures, report, and what sort of matters we should consider before accepting this particular assignment, and level of assurance that we are providing, and the nature, timing, extent of procedures. Actually, what is prospective financial information? So if I take this prospective financial information, that is a financial information which is based on assumptions. It is financial information. So it is financial information that based on assumption. Based on assumption. That is based on assumptions, and this can occur in future. So that is not historical. That is not historical. It is future oriented. It will occur in future based on assumptions. Based on assumptions, right? That is what called PFI. That is what called PFI. Okay. So if I take this PFI, prospective financial information, this prospective financial information can be a forecast, a projection, it can be a forecast, it can be a projection, or it can be a combination of both. It can be a forecast, it can be a projection, or it can be a combination of both, right? So that can be PFI. Okay. See, now we should understand forecast and we should understand about the projection as well. Let's see that first. What is exactly forecast? Simply ISAE, International Standards and Assurance Engagement 3400, it's clearly said that PFI, prospective financial information, is best estimate assumptions. It is best estimate assumptions. So that is a forecast, future oriented, but using best estimate. Using the best estimate. Clear? So the PFI can be either forecast or projection. Forecast means it is more accurate, not exactly accurate, to best estimates we used, best assumptions we used, right? So it is closer to accuracy. Projection, that is a mixture of best estimate and hypothetical assumptions. So comparing with forecast, projection consider or includes some kind of hypothetical assumptions over future events. So there are types of forecast, right? I told you there are two types of forecast. One is profit forecast. So profit forecast, expected revenue and the cost accrual basis, like similar to profit or loss. The forecast revenue will include the amounts of sales that we are expected during the forecasted period, right? And depreciation will be based on the expected level of assets held during the forecast period, calculating using usual depreciation rate. Normally profit, expected revenue minus expected cost. Expected revenue minus expected cost, right? So that is what called profit forecast. And the cash flow forecast, if you take this cash flow forecast, that deals with expected cash payment and expected cash receipts. Except expected cash receipt minus expected cash payments. Expected cash receipt minus expected cash payments. So that is we call cash flow forecast, right? So normally when it comes to cash flow forecast, only cash inflow and cash outflow to be considered. So non-cash items, you cannot take it. You might study that under IAS 6-7 cash flow statement, right? You might study this under IAS 7 cash flow statement sometime. Right. Now principles of useful PFI. Actually, PFI can be issued as an internal management tool. So we can prepare PFI for to support our decisions. And PFI can be issued, the prospective financial information can be published for the third party. In the annual report, we can publish along with historical financial statement, right? To inform lenders for the loan purpose, we can use. Ultimately, the usefulness of PFI depends on the requirements of the end user. Who is the end user, intended user of this PFI? Based on that, the usefulness of PFI depends. The unifying qualities of PFI that report address the specific need of the user and be prepared on a timely basis to enable decisions to be taken, right? Actually, if I take the acceptance consideration of PFI acceptance consideration is similar to other factors plus some other things are there, right? So you might study ISA 210, that is acceptance consideration. So ISA 210 acceptance consideration, ISAE International Standard on Assurance Engagement 3400 accept considerations, right? So both need to be considered. It does not mean that you should not consider the management, integrity, resources, those things we discussed under ISA 210. Along with that, 3400 International Standard on Assurance Engagement 3400 is also need to be considered. See here, as with any engagement, the reporting accountant must consider the risk of involvement with the PFI prior to accepting the engagement. The greater the risk of giving an inappropriate report, the greater the risk legal claims and the loss of reputation. Ultimately, if the risk is too high, the engagement should be politely declined. Normally, if the risk is very high, better to politely decline the request. And at the time, obviously you should consider several factors. All these are matters to be considered before accepting the engagement. Right, before acceptance. Before acceptance, what sort of things you should consider? The first matter, the intended use of the information. Who is going to utilize this information? Who is going to take decisions based on this information? That we need to consider. So here, intended use of the information. Intended use of the information. So basically, intend the use of information. Who going to use or rely on this information? That we need to see. That we need to check, right? See here, information for external use will be relied upon third party, potentially making investment decisions. But it makes risk accounted because consequences issues inappropriate report will be more severe. External users means the risk is very high. Because if something went wrong, and if they relied their decisions based on your opinion, the risk will be high. Whether the information will be general or limited distribution. What is general distribution? What is limited distribution? The general distribution means it is available for everyone. Limited distribution is restricted for certain people. So you should ask before you accepting, during the time of acceptance of the PFI, you should ask the intended use of information, whether internal management or external user, whether the information is general or limited. Nature of the assumptions. Right? If I take the assumptions, whether it is best estimate, that is forecast, whether it is best estimate plus hypothetical assumptions, hypothetical assumptions, that is what we call best estimate and hypothetical assumptions, that is what we call projection. Okay, so that we need to consider. The information is best estimate, it should be reasonable approximation. When the assumption is hypothetical, it's too difficult to validate. It's too difficult to validate. Right. So when you are doing a forecast, if you do a best estimate, that is reasonable approximation. But it is reasonable. Best estimate but hypothetical, then it will be more difficult to validate. It is more difficult to validate. The elements to be included in the information. The elements to be included in the information. See here, the engagement will be higher risk if the PFI include element which the accountant has little knowledge or highly subjective. So always the elements included in the information need to be assessed. If it is a high complex subjective, then its risk is high, right? And the period covered. Normally, if you are preparing a forecast for next 12 months, it's a best estimate. If you are preparing a forecast for next 5 years, the first year will be to some extent accurate, but the end of the 5th year, there is a risk. So long period, high risk, less period, less risk. So those are the matters we should consider during the time of accepting a PFI assignment. Now let's move the terms of engagement. An engagement report on PFI does not constitute an audit. So, however, the prospective client may not appreciate this fact. Agreeing the terms and engagement therefore critical to avoid misunderstandings of the client. So, when you accept a particular PFI assignment, it's better to define the terms of engagement, right? Like the nature of the procedures performed, the type of assurance offered, and the conclusion given, and management responsibilities, restrictions on the use and distribution of the report, right? So whether the report is general or limited, basis of setting the fees, all these things typically need to be considered. Right, when you are preparing the terms of the engagement. Clear? So these are the engagement letter should specify all these matters over PFI. The level of assurance, you all know, the moderate level, limited assurance, and we are not giving reasonable assurance, and the opinion is expressed negatively. So simply they said that nothing has come to our attention. So nothing has come to our attention to confirm that forecast consists material mistake. Right. So the level of assurance ISAE 3400 said it is limited assurance, moderate assurance, and the worded is negatively. The procedures. This is very important. So the procedures. See here, the practitioner should obtain sufficient level of knowledge about the business and the assumptions used by the management to prepare this type of financial information, prospective financial information. So when you try to get this particular assessment of PFI, you should know about the organization and the assumptions used by to prepare the PFI. So let's take the internal controls over the system used to prepare PFI. So on what grounds that they prepare PFI? What are the internal controls over the system used to prepare the PFI? Nature of documentation to support management assumptions. So how management use their assumptions and the documents to support management assumptions. The extent to which statistical, mathematical, automated tools and techniques used. What sort of statistical technique used, mathematical techniques used, automated tools used, right? Methods used to develop, apply assumptions. So what sort of methods used to develop and apply the assumptions? Accuracy of PFI prepare in prior periods and the reasons for significant variance. Right, so to what extent? Because last year's PFI is the current year financial statement. You can compare, and if there is any variance, you can assess. General procedures we performed under PFI. Practitioner should also consider the following when determining the nature, timing, extent of procedure. Right. So what is the possibility of a material misstatement? So knowledge that they obtain from the previous engagement. And management competencies, preparing PFI. External, to what extent the which information is affected by management judgment, right? So to what extent the management judgment get influenced, and the reliability of the data that we used, right? Always the data that we used need to be considered the reliability. Okay, so always we need to use the reliable and relevant data. Clear? Analytical procedures can be used to identify unusual fluctuations. Analytical procedures can be used to identify unusual fluctuations between the forecast and past performance. Right. So the forecast information and the past performance that we can compare. Right. So what you can do is you can inspect existing loan or lease agreement to agree the repayments included in the forecast. Inspect the quotations or price list to agree the forecast for new assets. Inspection of reasoned utility bill to assess the reasonableness of forecast over utility cost. Through that you can see whether that forecast is reasonable or not. The practitioner should obtain written representation from the management. For that PFI, practitioner should obtain written representation of the management by considering the intended use of PFI. What is the usage of PFI? And the completeness of significant management assumptions. Right. So normally the management assumptions are complete or not. And at the same time, management acceptance of its responsibility for the PFI. Management acceptance of its responsibility for the PFI. It is not appropriate for the practitioner to rely fully on the representation. You all know the representations are not reliable. So the practitioner must appropriately plan, perform and review range of procedures to enable them to obtain sufficient appropriate evidence for the purpose of offering assurance, right? So simply we cannot rely on 100% of the written representation. Okay, here see PFI procedures are given one by one. This is what examinable. See, compare the forecast amount to historical performance to ensure consistency. So last year's actual performance and last year's forecast, right? So through that current year actuals with last year forecast, right? You can compare to ensure the consistency, right? Compare the forecast amount to actual results. This is likely the time of PFI actually conducted, right? So you can take the forecast amount to the actual results to see the results of forecast, whether it is accurate or not. So the second procedure says comparison forecast amount to actual results. So if there is any variance, we can discuss. The actual results and the forecast need to be compared. Forecast for previous period may be also assessed in comparison to actual results to assess how accurately management forecast in the past. Right? And also see, reasonably certain income and cost may be verified by inspecting the documents such as orders, contract, loans, agreement, lease contract. So lease payment outflow that can be verified through lease agreement, right? And the comparison of accounting policies estimates used in the forecast in comparison to financial statements, right? Actually, the estimates and the policies they use that can be compared. Inspection of non-current asset register to identify if assets are approaching the high end of useful life require replacement, right? So these things that we can ensure through whether the forecast PFI is reasonable or not. Comparison of working capital to assess whether liabilities are met and the company can finance its short-term resourcing requirements. See, comparison of the relationship between reported figures. For example, if there is a significant increase in revenue, is supported by increased production cost, advertisement cost, distribution cost. And also you can calculate several ratios like margin, profit margin, operating profit margin, receivable days, payable days, inventory days to assess the working capital efficiency and the going concern part as well. If I take the report, it is like similar to audit report, but this assurance report is providing limited assurance. Right? So the format is same. See, title and addressee. Addressee is the intended user. Identification of the subject matter. Reference to any applicable laws or standards. A statement that management responsibility to prepare PFI. And reporting accountant's responsibility. Reference to purpose restricted distribution of the PFI. A statement of negative assurance as whether the assumptions provided are reasonable. You should say that assumptions are reasonable here. Opinion whether PFI is properly prepared. Limited assurance. Right? And also reporting accountant signatures, date of the report. Those things generally comes under the reporting part. Right? So if I take the questions, through questions only we can understand this part very clearly. So if I take the first part, they said explain the matters to be considered, accepting the engagement. Right? When you are accepting PFI, at that point what you should do? One question. Question number 2. Right? They gave the extracts. This is a balance sheet. Right? If I take this is what balance sheet. And if I take this is income statement. And then they ask explain the audit evidence respect to cash flow forecast you would expected to find in your review. Right? So here it's a kind of a performance stage. What is the evidence that you can obtain? Right? So those are the questions asked. But generally, if I take this past paper questions, if I take the past paper questions over PFI, if I take the past paper questions over PFI, the PFI questions are acceptance consideration, planning consideration, performing. This performing can be tested in 2 ways. One is matters to be considered, or else we can say audit evidence. Here it's procedures. And also they check about the report. So these are the ways to test PFI questions. Generally, the PFI questions can be tested either one of these ways. Right? So now let's move to the question. You are a manager in Hunt company a firm which offers a range of services to audit and non-audit clients. You have been asked to consider a potential engagement to review and provide a report on the prospective financial information of voters company, a company which has been audit client for 6 years. The audit of the financial statements for the year ended 30th April 2014 has just commenced. Waters Company operates a chain of cinemas across the country. Currently, its cinemas are out of date and use projectors which cannot show films made using new technology, which are becoming more popular. Management is planning to invest in all of its cinemas in order to attract more customers. The company has sufficient cash to fund half of the necessary capital expenditure, but has approached its bank with a loan application of 8 million for the remainder of the funds required. Most of the cash will be used to invest in equipment and fittings such as new projectors, larger screens, enabling new technology films to shown in all cinemas. The remaining cash will be used for refurbishment of the cinemas. The draft forecast statements of profit or loss for the year ending 30th April 2015 and 16 are shown below. Along with the key assumptions which have been used in their preparation, the unaudited statement of profit or loss the year ended 30th April shown below. The forecast has been prepared for use by the bank in making lending decision and will be accompanied by other prospective financial information including cash flow, forecasted cash flows. So the information is given here. If you take revenue 35,000, right? Forecasted 43,000, 46,000. Expenses 28,250, 31,500, 32,100. Profit 6,750, 11,500, 13,900. Finance cost 1,700, 2,000, 1,900. Profit before tax 5,050, 9,500, 12,000. Note 1. The forecast increase in revenue is based on the following assumption. All cinemas will be fitted with new projectors and larger screens to show new technology films by September 2014. The ticket prices will increase from $7.5 to $10 1st of September 2014. Note 2. Operating expenses include mainly staff cost, depreciation of property, plant and equipment, repairs, maintenance of the cinema. Right? So normally here, before accepting the engagement, what sort of matters we need to consider? What sort of matters we need to consider? Number 1. Matters before accepting PFI. Right? So already we discussed several matters, right? Actually, first of all, I'll give point form. Ethical consideration. Ethical consideration. Whether it is ethically right, whether it is ethically acceptable to perform PFI. You all know when you are talking about ethics, other assignments, self-interest, fee dependency. So those things we need to consider and we should ensure that ethically it is acceptable to perform this particular services, right? So when you perform PFI along with external audit, that will create self-review threat, that will create self-interest threat as well, right? And to some extent, if fee dependency exists, that will create an advocacy threat as well, right? So I could say that self-interest self-review, and advocacy. Right. Why I'm saying it is advocacy? Sometimes when you prepare this PFI is prepared for what? To get the loan from the bank. Right. In that case, you are promoting. Sometimes you might promote your client. Uh, that is treated as what? Advocacy threat. That is treated as what? Advocacy threat. Right. And when there is an ethical problem, it's better to discuss that ethical matters with whom? Charged with governance. You all know when there are the possibility of fee dependency, we discussed already that should be communicated to charge with governance. Right. So, ethical issues need to be communicated to charged with governance. Charged with governance. Okay, and also you need to consider the separate team to be used to perform work. Separate team to be used to perform the work. Right. So all these things to be comes under ethical issues. Ethical issues. All these things comes under ethical issues. Normally we studied this under ISA 210. ISA 210. We might discuss this is similar to external audit as well. Right. Now let's look at ISAE 3400. As per the standard, what sort of matters to be discussed? Right, because always you should consider the matters before accepting a PFI assignment as per ISA 3400 as well. Right, simply general report or limited report. Intended users. Intended users, internal or external. Internal or external, that need to be considered. Next one, period to be covered. See, if it is a period is long period, yes, obviously the long period risk is very high, short period the risk is very low, and the assumptions used, whether it is a best estimate of assumption or hypothetical statement. Hypothetical statement. And skills and competencies, whether staff have sufficient skills and competencies to perform the job. Right. So these are the matters we need to consider before accepting PFI. So if you're going to accept a PFI, obviously you should consider all these matters, right? And let's move to question number 2. Let's move to question number 2. This is Delhi. Delhi is a family-owned unlisted company, so it's not listed, which imports motor cars. The company buys cars from a variety of car manufacturers for the sale to car dealerships and vehicle leasing companies within its own domestic market. Delhi company has been a client of your firm for the last 3 years, and you are the newly appointed audit manager on the audit for the year ended 31st August 2008. The audit for the current period is nearing completion, and you are reviewing the working papers of the going concern section in the audit file. Extract from the draft financial statement and other relevant information are given below. Draft financial statement figures given, balance sheet given, profit and loss given below. See here, Delay company has undergone a period of rapid expansion in recent years and intend to buy new warehouse facility cost of 4.3 million. So they expected to buy new warehouse facility. In order to finance the new warehousing facilities, the company is in the process of negotiating new finance from its bankers. The loan application is for an amount of 5 million, and so is to be repaid over the period of 4 years. Over the period of 4 years. The provision of 3.5 million in this year's statement of financial position related to legal actions from five of Delay's largest customers. The actions relate to the claim that company has sold cars which did not comply with domestic regulations. A major competitor has moved into Delay's company's market in October 2008. The going concern working papers include cash flow forecast 12 month ending 31st August 2009. The cash flow forecast assumed Delay revenue will increase by 25% next year and following the reorganization and credit control facility. Its customers will pay on average 60 days. The forecast also assume that the bank will provide new finance in January 2009 and that the company will have a positive cash balance of 1.7 million by August 2009. The financial statement have been prepared on a going concern basis, make references to any significant uncertainty relating to going concern. Significant uncertainty relating to going concern. Okay, so they ask the audit evidence. They ask the audit evidence in this matter. They ask the audit evidence. So let's do that. Audit evidence over cash flow forecast. Audit evidence over cash flow forecast. Right. See, when I told you, sometimes there is a possibility they ask procedures, sometimes there is a possibility they ask evidence. When they ask evidence, I told you ISA 500 when we discuss matters to be considered, audit evidence obtained. When they ask matters to be considered or audit evidence, you should write audit evidence with the purpose. So here, see, evidence of agreement of the opening cash position to the cash book and bank reconciliation statement. Bank reconciliation statement, right? And we also reperformance by auditor of client computation preparing forecast in order to check arithmetic accuracy. And also a review of correspondence with Dali's bankers and supporting documents for the company's existing loan facilities. Existing loan facilities. Okay, so again we can say the minutes of the meeting can be check relating to the likelihood of obtaining new loan, right? So they plan to get the loan, so we can review the board minutes to see the occurrence when it going to be occur, likelihood of that particular bank loan. And we can obtain the written representation from management. We can obtain the written representation from the management confirming the cash flow forecast assumptions are correct, reasonableness of the cash flow forecast, right? So if we take those are the evidence, but here when you are writing evidence, you should write in the form of evidence, not write just procedures, right? So after that particular PFI part is done. PFI can be tested as a procedure. PFI can be tested as a planning, acceptance, consideration. So practice more questions on PFI as well, right? Thank you very much.